All right, good morning, everyone. Welcome to AllGen's quarterly update and market review. Today is October 16th, 2024, as we head into the last quarter of the year. And it's been a year, and it's yet another quarter of interesting things to possibly come. So we're just going to wait a few seconds here for some folks to get in here, and we'll get going, as I know Jason has a lot to cover.
Like we want to start with a poll question here, Paul.
Oh, okay, let's do that. Which we normally do this anyway. We'll get going. We love to get people involved and engaged. Um, so I just want to get your thoughts. A few questions have been coming in with interest rates, changing and things of that nature, and how inflation's happened. So in regards to real estate, do you think it's a good time to buy? Well, I guess it's an A, B, or C, to buy, to sell, or to just stay put, wait it out? So what would you think, in your professional opinion? Regards to real estate, is it a time to buy? Is it a time to sell? Or is it time to stay put? I'll give you a few seconds for everyone to answer those questions and see what the results say. Survey says most people say it's time to stay put. Okay. One person saying sell, a couple people saying buy. All right. Okay, but most people are saying stay put, which I personally kind of agree, but that's just my personal opinion. All right, let's go to another question. This is a little bit on a different front. For baseball fans out there, even if you're not a baseball fan, you're in the playoffs, and my son's a huge baseball fan, at least one of them. So, who do you think is going to win the World Series? Mets, Dodgers, Yankees, or Guardians? And for those of you, like many people who are not aware, I was one of those. The Guardians are the former Cleveland Indians. Now they're the Cleveland Guardians. So they're playing the Yankees in the semifinals. The Mets are playing the Dodgers. Dodgers are 1-1, and Yankees are up 2-0 on the Guardians. What are your thoughts? Who do you think is going to win the World Series?
Well, I know that Anna's choosing.
Oh, yeah. All right. Let's see what people say. We've got the majority thinking the Yankees. Okay. Well, Anna won't be happy about that. We're split on the Mets and Dodgers. So that means right now, like the series is split 1-1. So there's our crowd. No one gives the Indians a chance. I'm good with the Mets and the Yankees going to World Series. I'm from New York. I always just say Subway Series is great. It's also great for the New York City tax base. So either way, I win if either of those two teams go win. So anyway, thank you for participating. Let's get this going. As you know, we do this every quarter to keep our clients and our community informed of what we think we're seeing out there, our opinions and thoughts, and how we're doing some things to deal with and manage our clients' portfolios and financial plans. So we're going to always start off with Jason doing his market review and outlook. Then after that, I'll give some AllGen updates, and then we'll answer some questions. So you are allowed to ask questions. The raise hand feature is turned off, so we will leave the questions till the end so that we can get through the presentation. But please feel free, as Jason or I speak, to just type it into the Q&A box there, and then we'll circle back to try to answer. We typically are pretty good at answering every question that we get during the presentation. So you can do that as you go. And with no further ado, Jason, take it away.
All right, thanks, Paul. All right, so we're just going to do a little quick update on where the markets are in this first slide. So year to date's been a pretty good market overall. The S&P 500 is up 21%. That's the large cap U.S. stocks, and then next is the international, up 12%. Small caps are up 8%, and then bonds are up 3%. So across the board, everything's up this year. Certainly a welcome sight after we've gone through a pretty difficult 3-year period. So good start to the year so far as we go into the fourth quarter. And from a sector standpoint, somewhat interesting, utilities are actually leading out of all the different sectors year to date. So part of that has to do with interest rates starting to come down. Utilities typically are very leveraged, so they have a lot of debt. And so as interest rates come down, that is good for them. At the same time, with the whole AI and cryptocurrency, there's a lot of processing power, so big demands for energy. But as you can see here, you got communication services, second, finances, financials right there, S&P, technology, still doing well this year. And then actually, real estate's been the worst performing out of all of them. However, it's had a pretty big jump over the last few days. This is a couple days old. So I think it's up to the 10 to 12% mark now. So that's where we're looking from a sector standpoint. And then one thing that we've been talking about in this last few webinars is that there's been a huge move in the markets, and especially in like the S&P 500, and it's all stemmed from, or a lot of it has stemmed from the Mag 7 stocks. That's a term that they've given for the Magnificent Seven: Amazon, Nvidia, Meta, Alphabet, Microsoft, Apple, and Tesla. And we pointed out that, wow, these are great companies, and they have made humongous runs in their stock, and it always gets a little bit scary after stocks make huge runs and price and their valuations start to get a little bit more. So what this looks at, and it's a little bit complex, but as we go from kind of where the growth was, or actual growth was in the second quarter of 2024, you can see very high growth rates in most of these companies, except for Tesla. Tesla had negative year-over-year earnings per share growth, but the rest of them super strong, especially Nvidia, 151% earnings per share growth. But as we go, and that's a big reason why their stock prices have gone up so much, is because of how much their earnings grow. Earnings are a big driver of stock prices. But as you see here, as we kind of go into the third quarter, you see the estimates for third quarter growth, which is just wrapped up, and these numbers are starting to come out now, but this was the estimate. You can see how they've all dropped from the second quarter, the actual results in the second quarter, to what we're estimating in the third quarter. Every single one of these have dropped except for Tesla, and Tesla still being negative, but improved. And then the difference between the third quarter and the second quarter, the second quarter and the third quarter, you can see, like I said, they're all a drop in the rate of growth. It doesn't mean that they're having negative earnings growth. It just means that they're not growing as fast as they were. They're still good companies. They're still growing for the most part, but the momentum of that huge run in earnings is starting to slow. And one thing we pointed out is that these companies make up about a third of the S&P 500. And the S&P 500 has become very overweight in technology and communication area compared to historical standards. It's become a huge weight of the S&P 500. And so the direction of where these companies go is going to drive the S&P a lot. So they've started to drift back a little bit, really since July, as I'll point out in some of these other slides. But before I get into that, just kind of pointing towards the valuations, one thing that I was kind of pointing out there, if those stocks, because those stocks have continued to grow, their valuations, if you look at like price to earnings or even forward price to earnings, which means next 12 months price to earnings, has been much higher. You can see the levels of this is much higher than other areas of the market. I typically point out the small caps. I switched it up a little bit this quarter, and we're looking at mid caps. The S&P 400 is the mid caps right here. This one and this one are mid caps. And then this is the value side of the S&P 500. So you can see the growth side is a lot more expensive than both mid caps, and if we had enough room in this chart to fit in small caps as well, but also even the value large cap stock. So one thing to keep in mind as we move forward is when you have valuations that are much higher in one particular area, typically that leads to slower returns or lagging returns compared to other areas that have better valuations. So, throughout this year, we started adding a little bit more towards the value side, kind of leaning more on the value because there is better valuations there compared to some of the extreme valuations or high valuations and the growth side. Similar on this chart, just looking at a PEG ratio, this is PE divided by growth. It takes into the not just a valuation standpoint, like price to earnings, but also how does that compare to its growth? And the lower the PEG ratio, the better the valuation. And again, both the S&P 400, further to the left, that's lower. That's cheaper than some of the larger cap stocks. So all that to say, that's something we've been talking about for the last quarter. You started to see a little bit of a rotation. Now you can see here, this is comparing the S&P 500 value, so the value side versus the growth side. and value did 9% versus growth up 4% for the third quarter. And then same thing from the small cap. Mid caps are pretty similar too. Both small caps and mid caps outperformed, small cap being the gray versus large cap being the blue here. So, over time, while it doesn't happen exactly when you think it's going to happen, but usually over time, the money will start to drift out of things that are more expensive and into the better valuations. So another thing that looks, we continue to point this out, I almost feel like a broken record, but, from a valuation standpoint, international stocks are extremely cheap compared to historical references. So usually, historically, international stocks are cheaper than US stocks. And a lot of that has to do with just kind of the way the US is, where we tend to be a little bit more capitalistic and a lot more focused on profits. Whereas international companies, that's not always their main focus. So they typically do trade at a little bit of a discount. So the chart here on the left shows normally they would trade at about, you can see here on average, a 17.3% discount compared to US stocks. But right now we're at 2 standard deviations, the cheapest we've been in like 40 years in terms of international stocks compared to the US. And again, typically when that happens, you have the area of the market has a lower valuation will tend to outperform over the next 5-10 years over the one with the higher valuation. So that something that we've considered. A few years back we started to notice this, started to add a little bit by a little bit to more the international side, where we were really underweight while the US was continuing to outperform international stocks. We've started to bring that up almost to kind of what we would consider the benchmark rate of what you should have in international. Now, part of the reason why the US has done so much better is looking here on the right side of the chart, is that if you look at earnings estimates and you look at the gray line right here being the US, earnings estimates and earnings, like I mentioned before, are a big driver of stock prices. You can see how the gray line, the US here, has continued to go higher and higher as earnings have improved. That's been a big driver of why the US has outperformed. But over the last like 5 years or so, you could see this is China. China's earnings have been going down. And then you see kind of even some of the Japan, Europe, and emerging markets kind of went more sideways during that time. However, if you just look in over the kind of the last year or so, see how all of these have started spiking up. So now you're getting growth back in China, you're having growth in Japan, growth in emerging markets, and growth in Europe. So now if they continue to grow, even if they grow at a similar rate as the US, and historically there's been times where they've grown much faster, but even if they grew at the same rate, you combine that with the lower valuation, and then what you should see happen is international stocks could start to outperform in that time period. And that's actually happened over the last 1 quarter. In the third quarter, you can see, this is the Vanguard ETF that kind of represents all international stocks, is up 8% versus the S&P up 6%. Very busy chart, but a fascinating one. Big news in the last month. There was a major stimulus package that came out in China that has really caused their market to go from a very weak point to really spiking up. You can see the blue line here being China. Over the last month, China stock index, especially this particular ETF that represents China, up to 22%. And really all that happened in about 3 weeks. It's been an astronomical rise. And emerging, that also, when China does well, it typically pulls up emerging markets in general. And you can see emerging markets are up 8%. In fact, China is usually the largest weighting in the emerging market index. But when China is strong, like I said, it tends to pull up emerging markets. It also helps global growth. And so if we look here on the chart on the right, the US, this is as of 2023 global GDP. The US is still the largest economy in the world at 26.9 trillion. However, China is second at 19.4 trillion. And so it is, from a global economic perspective, if China starts to struggle, that hurts the global economy. If China is growing and the US is growing, that's typically good for the global economy. So the fact that China has started to increase a significant amount of stimulus, both by lowering interest rates a lot and some fiscal stimulus that's also coming, and some subsidies for lower income households, all to kind of get their real estate market going, that's really been struggling. If you get that stimulus, it tends to drive the global economy into a stronger position, and especially countries like Brazil, and especially a lot of the Asian, Vietnam, and a lot of the other emerging markets around the world, in India, they tend to do better when China's doing better, but the global economy as a whole does. So last chart on the stock side of things, there is something that's called, well, Ned Davis Research puts out this report, NDR, a crowd sentiment poll. And it's one that I like a lot. It's pretty complex, but it's simplified something that's really complex. And it's basically measuring a lot of different sentiment indicators to determine if the market is kind of, if the sentiment of the overall people that are involved in the market, if it's too complacent, kind of greedy, euphoric, that typically those types of characteristics are usually near tops of the market, or if it's fearful, and scared and near capitulation, that would typically be near a bottom. And it seems counterintuitive, but when the markets are the most scared, that typically is when the returns of the market is the best going forward. And when the markets are most complacent, that's usually when markets tend to struggle. And logically, if you follow the process, it makes a lot of sense. If everyone is extremely euphoric and excited about the market, they've probably already invested everything they could in the market, and there's no cash left over to invest. You lose that demand that drives the market up, new cash coming in the market. Whereas in the opposite side, when everyone's extremely fearful and thinking the market's going to drop further, then they've probably sold out the majority of their positions and they have a lot of cash. And so if there's a lot of cash on the sideline, that allows for the market to potentially go up. So right now, we are in the extreme optimism, as you can see above this dash blue line, which sits at 66 right here. So we're right now above 66. And in that time period of above 66, which happens about 28% of the time, markets are essentially flat. So the percentage gain per annum in that type of environment is about 0.79% when we get into that area. And you can see when the sentiment is coming from extremely scared to getting not as scared, that's the best environment. Returns close to 20% per year. And even when we're in the kind of extreme fear, that even does 11% per year. So I point all that to say that stocks have been really strong. They've done really well. The economy has been stronger than what a lot of people thought it was going to be this year. But we do have to also weigh that into where sentiment is right now, and understand that just because the market has been strong doesn't mean it's going to continue to be strong. So we have to kind of look at all the different angles of what drives markets. All right, so switching from stocks, getting into the dollar. This dollar chart goes back to the middle of 2021, kind of as we were starting to come out of the pandemic. Inflation was starting to take hold in 2022 and in 2023, and you had interest rates going up. Interest rates and the dollar are very much correlated. So as interest rates go up, the dollar tends to get stronger. As the perception of interest rates are starting to come down, meaning people think that the interest rates are going to start to come down, the dollar will start to weaken. So you can see, kind of as we're going into 2023, and especially into 2024, we're thinking, okay, the Fed's eventually going to start to cut rates, and that's when the dollar started weakening. And then, the Fed did have its first rate cut a month or so ago, and they dropped it 50 basis points or 0.5%, and you see the dollar started weakening in anticipation of that. However, some stronger than expected economic reports have started coming out over the last month. And, then the perception is, well, maybe the Fed won't cut as many rates as we thought they were going to cut. And so the dollar over the last month or so is starting to come back up. So right now, as a whole, we've kind of gone into this sideways channel where, you have the support down here, and then you have kind of resistance right here. and we've been kind of going back and forth in this channel. We have broken the long-term uptrend, that's this gray line, and broken down below that, but right now we're kind of stuck inside this channel. So from a technical standpoint, what we're looking for is, are you going to break below these lows right here, which would indicate the dollar is probably going to continue to go lower? Is it just going to stay in this channel and go sideways, or if it breaks out above this area and get stronger? The fact that it did break this longer term trend line and interest rates are starting to come down would lead us to believe that it's probably going to start to get weaker. But if economic reports continue to come in a little bit stronger than expected, then you could see the dollar get stronger. The dollar has a lot of ramifications for multiple things, but one in particular is, as the dollar weakens, that's an inflationary scenario. Gold tends to do very well in an inflationary environment. This is a very long-term chart of gold, but really kind of focusing in over this last year, you can see we broke out above this resistance and it's continued to go higher. Not a lot of people know this, but gold has actually outperformed the S&P this year. It's up 28%, where the S&P is up 24% as of yesterday's close. So gold has done really well this year. And if the thought process is that we're going to go into a more inflationary time, gold should continue to do well. I think this is a very fascinating chart, being the nerd that I am. But this is gold divided by the S&P 500. And the way you read this is, when this line is going up, gold is outperforming the S&P. When this line is going down, the S&P or stocks are outperforming gold. So you can see we're from 2012 up until about right now, for that longer term time period, the S&P stocks in general have been stronger than gold. However, this tends to be long-term trends when you have a break of this trend, and we haven't broken it just yet, but we are looking for, not necessarily anticipating, but we're looking to see if this is going to break out, where you see gold start to outperform more from a longer-term perspective stocks. And we're overweight what we would typically hold in gold. And if that's the case, we may go a higher weighting if that happens. So something that we're closely monitoring. This is kind of giving some of the reasons behind why gold has done well. One is that we've been in an inflationary environment. Gold typically does well in an inflationary environment, but at the same time, there has to be demand for gold in order for the price to go up. So you have to have people buying gold. And what this chart is looking at is, what is the expected change in global central bank holdings of gold? The dark blue meaning they're going to increase their holdings. The green remain unchanged. The pink means they're going to decrease their holdings of gold. And then this is a little bit hard to read over here, but this is starting in 2019, going up to 2024. And you can see, especially since 2021, and even after the pandemic started, central banks have increased every year in terms of they more and more are continuing to buy gold to hold in their central bank. And the reason why they do that, and this chart gives you the reasons. The main one is an inflationary hedge. So you can look here, there's two on this bar chart. There's emerging markets, and then there's advanced, sometimes called developed markets. But it's kind of, what percentage of all the emerging markets or advanced markets believe that this is the reason why they would hold gold, or a reason why they'd hold gold. So it's an inflation hedge, typically performs well during a crisis. They just have a historical position, a portfolio diversifier, a geopolitical diversifier, no default risk, and it's highly liquid. And I point this out to show that these are some of the reasons why we think it's also important to hold in a portfolio. It is a good inflation hedge historically. It does typically perform well during a crisis, and not just during a crisis, but in a recessionary time period, in a slowdown. And it's a great diversifier because it's not as correlated. And one of the main things that we try to do when we build our portfolios is to build a portfolio that has non-correlated assets, meaning assets that don't all go up and down together. And so, having gold as one of those non-correlated assets makes a lot of sense. And gold tends to be a lot safer than some of the other commodities, like a silver or copper, or even getting into some of the food and other agricultural products. So One thing that we want to closely monitor here, and this is what the Fed is also closely monitoring, is inflation. And certainly a lot of progress since we hit a high of 9% inflation. The blue line, dark blue line being the headline US CPI, the light blue being the core CPI, and then the Fed actually pays a little bit more attention or puts a little bit more weight on the PCE. So you have the gray is the headline, and then the core is the green. Difference between the headline and the core removes some of the more volatile assets like food and energy. So it's important to look at both, and you can see here really since kind of the end of 2022, they've all been coming down and trending much lower. The Fed wants to see, kind of has a 2% target. So they want to see that in order to determine if we are in an inflationary environment. If we're above that, they typically don't cut rates unless they're anticipating it going below it, which is what they're doing now. If we start to get below it, then they can start to, then that's showing that it's more of a kind of a disinflation or deflationary environment. So all that to say, while the trend is down, if you pay close attention to the core components that are not, so the core PCE and the core CPI that is not as volatile, meaning from food and energy, that the core PCE is this one right here. It has started to kind of flatten out and go sideways. And then if you look at core CPI, same thing over the last couple of readings, it started to go sideways, but it's going sideways prior to getting below 2%. So that's going to be something really that we want to monitor as we go forward, because if that doesn't continue to go down and get below 2%, it's really not going to allow the Fed to continue to cut rates. Or if they do, it's going to risk, causing another inflationary battle where inflation starts to go up again, which is not what they want. So they're trying to walk a line of, trying to stimulate the economy because the economy has slowed down, but not stimulate it so much that they cause inflation again. And this is a really cool chart, but this kind of breaks down the different areas of the CPI, being energy, food at home, shelter, core goods, dining, recreation, other services, and then auto insurance. And you can see the CPI has got to 2.4%. So like you said, like I showed in the last chart, it has been coming down, but part of why the headline numbers come down quite a bit is because energy and some of the core goods have actually been negative over the last couple readings. But if energy, some of those core goods come back up, that could, if the economy, which happens when the economy tends to strengthen, that could cause inflation again. So one of the biggest ones, or the biggest one, is shelter. Shelter was a big driver, meaning homes, home prices, and rents and stuff like that. So that was a big driver of inflation, up until kind of the beginning of 2023. And you can see actually the growth of the inflation of shelter and housing has started to come down. Still growing, it's just growing at a slower rate. So that definitely helps the core numbers, because that's one of the biggest component. If you just think about your own budget, typically your biggest line item is your rent or your mortgage. So as that starts to come down, that tends to look better for inflation. All right, so inflation is a big thing that the Fed looks at. The other big one is jobs. Unemployment, people working, that is super important to drive a strong economy. So as people, the more people are working, the better that is for the economy. The chart here on the left side is one that we've been focusing on for a while. This is job openings, the blue line. So job openings, around the country, how many jobs are open across all the different corporations versus people looking for jobs, the total unemployed, that's the gray line right here. And so, when we had really strong inflation, you had almost 2 to 1. You actually had 2 to 1 job openings for people looking to work. When you reach that scenario, it's hard to find labor, and you have to really pay a lot more. It causes wage inflation, and when wage inflation is around, that causes, when people make more, they tend to spend more. So, what we've been saying is you want to get this more to parity to take away some of the wage inflation, which is a big driver of inflation. And if we just zoom in on the unemployment component right here, You can see that a little bit better once you get away from the skewed time frame of the pandemic. But you can see how this has really started to increase a lot. And so now one thing to point out here, that going back to around 1950, when you have a rate of unemployment that has increased at the rate that we have increased over the last year, every single time a recession has happened. And it's like 10 out of 10 times. So I'm not saying there's going to be a recession, but I'm just saying historically, that is what's happened every time you've seen unemployment go up to this level. Now, I'm actually probably in the minority to say that, we could be going into a recession. Most people think we're going to have more of a soft landing. Even some investment team at AllGen leans in the soft landing camp. And so I'm right about 50-50 right now if we have a recession or not. But just to point out, there's been a few things popping up, especially unemployment, that has always led to recession in the past when similar things have happened. Whether that happens or not, again, this time, no one knows the future, but it's something that we need to be aware of. Seeing that this is starting to happen, we've dialed back a little bit, took some gains off the table from our stocks, increased bonds a little bit as interest rates come down, just to kind of protect the portfolio and go a little bit into a defensive posture, but still we're not overly defensive. Very, very interesting chart here again on employment, because employment is super important. Hires, you can see, companies hiring has started to drift down, and we're back towards levels of kind of 2016, 2017. And there's something called a quit rate or quits, which that's important too. When you monitor how many people are quitting, that tells you a lot. When a lot of people are quitting their jobs, like we had over here, they're quitting because they think they can easily get a better job. As quits start to decrease, the mentality is, I'm going to keep my current job because if I quit, I'm not sure I can go find a new job. Just another reason to another indicator that we're looking at that points out to say, hey, the job market has gotten a little bit more difficult. We still have more job openings than people looking for jobs, so it's not bad, but it's definitely weakened over the last few years. So something to continue to monitor. Now, one positive thing that has, and this is something that has caused, the Fed to kind of hold back from cutting rates recently, is that we did have one jobs report that was pretty strong, but at the same time, the economy had a pretty strong recently a report, the last report in the Purchasing Manager Index for the services side of the economy. America is driven much more by the service side of the economy than it is the manufacturing side of the economy. So it's important to pay attention to what services are doing. The last time we had this quarterly review, they were both kind of pretty close to this recessionary, below 50, contractionary. Now you still have manufacturing in a contractionary area, but you can see here services have really spiked up recently, and services, is now at the highest point that it's been in the last couple of years. You can see it can be volatile, so it may just be one reading, but that is something encouraging from the economic standpoint that shows that the economy is still pretty resilient, especially on the service side. All right, so as we go forward, these are all the things that kind of the Fed is looking at to say, if they're going to continue to cut rates or not. The Fed has been all over the place. Well, the market, I should say, the market expectations for what the Fed is going to do has been all over the place over this last year. But where we're landing at right now, in terms of where the futures market is predicting the end of the year is going to be, there's about an 82% chance that we have two more rate cuts, that we end up in the 4.25% to 4.5% on the federal funds short-term rate by the end of the year. A small chance, 17%, that we'll only cut once, and an extremely small chance that we stay where we're at right now. Now, before some of those stronger economic numbers were coming out, there was actually a decent chance that there was going to be 3 rate cuts by the end of the year. But now that it doesn't even show that as a possibility right now. All that to say, most likely what's going to happen is you have one rate cut in the November meeting and one rate cut in the December meeting, and we end the year with 4 rate cuts. All right, so this is just kind of looking at the Fed funds rate, where it came from, And then what's really interesting is the Federal Open Market Committee's projection, the red line, versus what the market expects. And I've shown this chart every single quarterly webinar over this last year. At the very beginning of the year, the market expectations were much steeper. And then the economy started to really strengthen towards the middle of the year. And then the market expectations were for almost no rate cuts. But kind of ironic, we end the year with both the market and the Fed kind of projecting the same thing. And that's where we kind of end the year around 4.25. And then by the end of next year at around 3.25 to 3.5. And then you have a little bit of a differentiation in between what the Fed expects and the market expects for the long run. The market's expecting to kind of go a little bit more sideways and not cut anymore. The Fed looks like it's planning on still cutting a little bit, but that's a long term in the future. Who knows what will happen between now and then. Okay, so bonds have definitely done better than the worst market that they ever came from over the last 3 years. But it's not everything up. Everything is up over the last 12 months, but over just this year to date, the longer term treasuries are down 5.2%. Actually, this was as of 10/14. They were up a little bit yesterday, but they're down about 4% right now. So, but the strongest area has been high yield, or what's called junk bonds, in emerging markets. And those tend to be the highest correlated bonds to stocks. So when stocks do well, these typically do well. You see the aggregate right about the 3%. So just the general bond market up 3%. Now, we're coming off one of the worst bond market of all time in U.S. history over the last 3 years. So as the Fed continues to lower rates, assuming they do, that should be a really good thing for bonds. And so that's why we've been starting to overweight bonds. We've extended duration a little bit more than the benchmark, because as the Fed lowers rates, that typically is good for bonds. That being said, we have to keep an eye on inflation. If inflation doesn't come down, starts to flatten out, the economy starts to strengthen a little bit, we may have to go shorter duration and reduce our bond portfolio, our bond holdings. So, I point this chart out. This is looking at delinquencies. Something that we've been monitoring a little bit to kind of see, where are some of the kinks in the armor, if you will, of this economy. The economy has been strong, and the consumer has been very strong. But one thing that could bring down the consumer and hurt consumption is if we start having a lot of delinquencies. Delinquencies are kind of an early sign that people have run out of cash and they're starting to borrow more and more until they've reached their credit limits, and now they can't even make their payments. So the gray line being credit cards, it's up, as you can see, the highest point it's been in about 13 years. And same thing for auto loans, a lot of delinquencies there, highest point it's been. Nowhere near the financial crisis, that's these peaks right here, but they are trending up, and they are the highest they've been in a long time. I think at some point we're going to start to see student loans do the same. There was a moratorium for student loans for a long time, and then there was an option when people with student loans had to start paying it back last year, where they can delay their payments 1 more year. And as of October, we've reached that 1-year period. So you may start to see student loans now start to come up as well. But that's just a kind of a red flag we want to keep an eye out for. If you have more and more delinquencies, that could mean that consumers are starting to get in trouble. And 2/3 of our economy is run off of consumption, buying things. And then one other thing, so that was the consumer. This is looking at more of the federal budget. I think everyone's aware that we have an extremely high level of debt. I think it's 33 trillion last time I looked. Could be $1 trillion or $2 trillion higher. But I don't look at so much the dollar amount, because there's inflation over time. But I think the better way to look at it is looking at debt compared to GDP. The debt divided by GDP, which is this right chart. We hit our highest point after World War II, but right now we're getting close to where we were in that World War II. And then if we look here, the gray line is pointing out where the CBO, that's their baseline forecast. And then if the Trump tax cuts get an extension and they don't raise taxes, this is what the CBO is forecasting, where we'll be in from a debt level to GDP. And so either way, both of them are showing that we're going to pass our all-time high in terms of debt. So, and unfortunately, it doesn't look like either candidate is really running on balancing a budget. So as of right now, there doesn't seem to be much hope for starting to improve that. So it's one thing to look at where our debt levels are. The other thing is looking at deficit. A lot of times people get the word debt and deficit confused. Deficit is on an annual basis. How much tax revenue do you have coming in versus how much are you spending? And right now we have a large deficit in terms we have not enough tax revenue coming in, or another way to put it, we're spending way more than the tax revenue that we have coming in. So we're running, about a 7% deficit right now. And, if we look at that kind of where we were historically, this is where we're at kind of right now, typically where we were historically is down here, 2 to 3% deficit. It'd be nice if we didn't have any deficit. But from an historical standpoint, I'm not sure how sustainable that is if you continue to run really high deficits like that. I don't think this is an emergency at this moment. I'm not trying to paint that picture, but it's something that we want to continue to monitor, especially if interest rates stay high or even go higher, because as the U.S. has to borrow to be able to pay for the operational expenses to run a country, what happens is you end up taking on more and more debt. But if interest rates are higher, that means you are paying more on your debt. And I saw recently that the amount of interest we're paying on our debt is higher than our defense budget, which is up there in the top 3 line items next to Medicare and Social Security. So just something to keep an eye on. I'm not sure how much longer we can continue to run deficits like this. At the same time, I don't think it's a critical thing right now, but you have to start to fix it at some point, or it could have some bigger problems. And that's where you can run into some issues with the dollar. All right, so we told you last quarter we would do some kind of in-depth research on the elections, and this is on a lot of people's minds. And what I'm showing you in this chart is the annual S&P 500 return going back almost 100 years, 90 years or so, from 1933 to 2022, looking at a couple of different scenarios. So you have Democrat president on this side, Democratic president versus a Republican president on the right side, and then you have the Congress, obviously made up between the House and the Senate. So if it's a fully Democrat Senate, that would be blue. If it's divided Congress, that would be red and blue here in the middle, and then a fully controlled Republican Congress. So, as you can see, a divided Congress has typically been best for, regardless if it's a Democrat president or a Republican president. Divided Congress has typically been better. And so if I look at this from the standpoint of where are we at right now, some of you guys are probably going to laugh at this, but there's a reason for my madness here. This is looking at the betting odds for the election. And the way I think about betting odds is kind of like the futures market, where I think polls are not as accurate as like the Vegas betting lines, the different betting lines out there, because bookies don't like to lose money. And so they want to get this right in terms of what the percentages of each president, the Congress, the House, the Senate, if they get this wrong, there's money on the line and they can lose a lot of money. So that's why I think it's more like the futures market, because there's money on the line for these different lines versus a poll that they could target different populations that may skew the results, where this is actually money on the line. And as of yesterday, right now is about a 55%, 56% chance that Trump would win, and about a 43% chance that Harris would win. From a trending standpoint, they were neck and neck about 2 weeks ago. And there was a point in time where Harris was looking like that. She was actually had a higher probability to win than Trump. But recently, Trump has been trending that he's more likely to win. It's still super close, and no one knows the future. Obviously, things can change. Still have a few weeks left. There's about a 55% chance that the House is controlled by Democrats, and about an 80% chance that the Senate is controlled by Republicans. So as of right now, that divided Congress, it looks like it's the most likely case scenario as of right now. So flipping back to this one, the scenario you're at right now in terms of where the betting odds are this scenario right here. And so, you know, I say this because people like to hear it. At the end of the day, you know, I don't have the slide up here, but if you go back to the beginning of America, there's about a 0.2% difference if it's a Republican or Democrat president. And so it really doesn't make a huge difference from the standpoint of market returns, who the president is. Now, there is a little bit more differentiation of who leads the Congress and Senate. So that actually has a little bit higher of a weighting. I put this last slide in here to show, you know, on the left side here, I've shown this in the past, but it's something super important. Like if, you know, we have sometimes, you know, you have kind of more your Republican clients that like, oh, if Obama gets in or if Kamala gets in, you know, we're going to pull out of the market. Or then you have more of the kind of Democrat clients and more, you know, usually they're both kind of a little bit more on the extreme side. Oh, if Trump wins, I'm getting out of the market. And you know, if you were only, so this is looking at since 1953, if you were to invest $1,000 only when a Republican was in president, you'd have 27,400. Versus if you were invested when a Democrat was in office since 1953, this is just the president, you'd have 61,800. And this isn't to point out that Democrats did better than Republicans. Really, what this focuses more on this right here. Now you put that into perspective of what if you just remained invested the entire time, regardless of who was president, your $1,000 would be $1.69 million. So the clear point, hopefully, I'm trying to make here is that do not base your investment decisions on who's the president of the United States. They really don't drive markets. There's so many other more important things in cycles, debt cycles, business cycles, global economy that has such a much larger factor than who the president of the United States is. And I'm not saying, you know, what's important for a country. I'm looking at this purely from the standpoint of market returns. It is not a major factor, and you should not put your, you know, you should not invest your money based off of it. All right, so wrapping things up. You know, so while stocks have been very strong this year, valuations, especially in large cap growth stocks, have gotten a little bit high. And at the same time, you know, sentiment does warrant a little bit of caution right now. But there are some attractive areas that are better valuations right now, as I pointed out, kind of more mid cap, small cap, especially on the value side. And then international still looks like pretty decent valuations, and gold has done pretty well and looks like has potential to do further based off of demand and inflation. The Fed has officially started cutting rates, but the question now becomes, how long will they continue to cut rates? Is the economy going to strengthen and start to get stronger, which means they can't cut rates anymore, and inflation is starting to come back, or does the economy get really weak and they're going to have to cut them faster? So that's something we're having to monitor and adjust the portfolio based off of which direction they go. And again, while elections may cause some short-term volatility, especially if it's close, the market doesn't like uncertainty. So regardless of who it is, if it's close, that could cause a little bit more short-term volatility. But regardless of who wins, that removes that uncertainty of who's going to be president, and then it tends to be good for the market when there is certainty. But regardless, you know, it doesn't have major long-term effects from a stock market standpoint. And I would really encourage you guys not to base your investment philosophy on who's the president of the United States. So as always, you know, we really try to, you know, have a very disciplined, diversified strategy that combines non-correlated assets where we want to manage risk first. And as always, you know, if you have any questions, feel free to reach out to your advisor. We provide market updates for them on a weekly basis, so they're well informed of what our strategy is, what the economy is doing, and they'd be happy to help. All right, Paul, back to you.
All right. Thank you, Jason. As always, a wealth of information, a lot of going on. So we want to shift gears quickly as far as non-market related things are going on. But before I do that, please feel free to ask any questions. You can add them in the Q&A section in the bottom there. Again, we'll get to those after I present a few things that are happening from more financial planning side that could affect you directly today that you can control versus the markets. So just please feel free to continue asking questions. And I know there's a lot of information here. Do not fear if you didn't get it all or take copious notes. We do send these out in a recording. So within 24 hours, you should get an email with this recording. So you can pause and see it in a little bit more depth. And beyond that, as you know, we like to keep you informed on various issues. So we were constantly updating our website with our blog and YouTube videos on different topics, not just market related, but also, am I ready to retire, long-term care insurance, all kinds of different topics, tax minimization strategies, etc. So please feel free to subscribe to our YouTube channel and look out for our blogs where there'll be a broader array of topics. And if you have something that you'd like us to cover, please feel free to send it in. As I know we have these conversations with our financial planning clients on a periodic basis, but always looking to see what's of interest to our people. So that being said, want to give a few updates. I said a few. There's quite a lot happening here. And fourth quarter is a busy time for various reasons. Medicare enrollment opened yesterday. So you're of that age, you can do, the supplements you probably getting marketed to by a lot of these companies that are want your business. So between October 15th and December 7th is that enrollment period. And there's also what's called a beneficial ownership interest report that's now being required of business owners. They have to be required, they have to be submitted by January 1st. If you're working with an accountant, hopefully your accountant has prompted you to do this already. Okay, there are a few exemptions. Won't get into the details here, but just be aware if you're a business owner, you may have to file one of these reports by the beginning of January, coming up in a few months. Okay, tax filing extensions. Tax filing for Floridians especially has been extended. Normally we have September 15th for business, October 15th for personal. The personal extension is now out to February 3rd for Floridians. A lot of that is because of hurricanes. Speaking of which, if you or anyone you know has been affected by hurricanes, one, our prayers and thoughts are with you. But if there's anything we can do to help from a financial planning or resource perspective, we've had we've had some of our staff that were affected mildly, and clients and friends, everywhere here by Helene and Milton, even in North Carolina. So please feel free to reach out to us, or if you just want to discuss some issues because you have insurance claims or anything that's financially related and could affect your financial plan, please feel free to reach out to us. Again, our thoughts are with those affected. And speaking of affected, if you were affected by Helene, you have up till May 1st to file your personal tax returns. Okay, obviously you have to prove what that means, and the IRS has its own requirements for that. But just a heads up, you probably knew about the extension already because the extension would have been beyond today, which would have been yesterday. So other tax considerations, staying on the topic of taxes, as we approach the end of the year, there's options potentially to do some charitable giving. And you've heard us talk about this. There's a blog that we do and a YouTube video about charitable giving and what stacking of strategies with a donor advised fund, which is a DAF. So just feel free to reach out to us if you want to consider or ask if a DAF makes sense for you, or if there's ability to take advantage of some of the structure that charitable giving affords, given legislation. And also, if you're a small business owner, you have till the end of the year establish a few retirement plans, such as a 401k, solo 401k. A SEP is extended to your filing deadline, so you would actually be available to do that through to next year. But end of the year is a special time. If you're going to establish a 401k, do not wait till December to start doing this. It takes a few weeks to get a 401k established. So I encourage you to think about that. This season is also a busy time for employer benefits. Usually it's open enrollment. Okay, so as we do planning, we sometimes say, hey, you might need more insurance or get that long-term disability, etc. So be aware, this is that time. I know sometimes these emails get buried in our inbox. Oh, it's open enrollment season. So I just wanted to bring that to top of mind in case in your financial plan it was mentioned, hey, don't die till you open enrollment so you can raise your insurance benefits or things of that nature. Also health insurance, if you are self-employed or if you buy your own health insurance, it does open up now the end of the year. So I think it's November 1st to January. So you can adjust your health insurance. Typically it rolls over if you already have it. And then required minimum distributions. While we typically stay on top of this for you guys, if you are in that category where you require a distribution from your IRA, your qualified plan, we'll bring that to your attention. But if you're not sure, please feel free to call us. We don't like the IRS levying penalties because we didn't do it. Okay, so please feel free to ask if you're in that camp or not to your financial advisor. So I know that was a lot again, but I just want to, I know we're approaching a deadline here of an hour, but I did want to do one more thing is welcome and introduce someone to the team. We've got Andrew, who graduated from UCF. Okay, so he's local to us here in Orlando, currently preparing for 65 and plans to pursue a CFA level 1 certification. He's local, again, born and raised in Oviedo. He spends time reading, exercising, watching sports. And he's dedicated to learning how to invest wisely so he can eventually pay off his student debt and enjoy financial stability. So Andrew's joined Jason on the investment management team. So when you come to the office, you see him around, say, give him a high five or, welcome to the team. So we wanted to welcome Andrew. Thankfully, we're growing and excited about what he's going to contribute, has already started contributing to the team and his future with AllGen. So that being said, again, feel free to continue asking questions. I am going to shoot quickly because there's a few minutes left. Some questions that have come in. So Jason, you mentioned an indicator that signals the market might be flat. So if that's the case, what do we do in our portfolios to grow?
Yeah, I'm filling that chart.
Yep, I think you just passed it.
Yep.
Was it the Ned Davis?
Yes, the sentiment one. That's right.
That's
yeah.
it.
So good question. This looks at the S&P 500. So the S&P 500 can be more flat during that time. Now, this is just saying that it has a 0.79% chance. That it has on average a 0.79% return when it is above that 66 line right here. As soon as that gets back below that, you can see that the returns have started to improve. So that's not saying, hey, over the next 10 years, it looks like it's only going to, or historically, is only averaged, a little over 1 or less than 1%. So it's really what this means to me is, hey, it's time to be a little bit cautionary right now. Especially we're kind of going into potentially some short-term volatility with the elections. Seasonally, this is the weakest time of the year. October tends to be. And so, I think I wouldn't put much weight on this for what long-term returns look like, but more so as we actively manage the portfolio and we kind of adjust here and there. We've already made the adjustments to be a little bit more defensive in the short term. We'll wait for sentiment to come down, wait for valuations to come back down, and then maybe and practically speaking, that meant what we did was reduce stocks a little bit, go a little bit more into bonds. We actually put a little bit into cash as well, high yielding money market ETF. And then what we would do is, as the market does come down, assuming it does, over the next few weeks or month, then we just take a little bit of that cash, a little bit of bonds, and we put it back on the stock side. So that's the plan. It never unfolds exactly as you want it, but that's kind of our base plan right now. But we constantly, we try not to have any bias of which way we think the market's going to go, but more make our decisions based off of a weight of evidence approach. Meaning, if a lot of things are kind of starting to line up, then we try to get in the direction of what's the highest probability.
Gotcha. Very good. And here's a question, and good one, based on the fact that we asked how people felt about the housing market. Being that the last few years housing has increased so much, and now we may potentially, in your opinion, go into recession and wages maybe not have increased that much. Are people being priced out of buying houses?
Yeah, certainly I think a lot of them have, and that's sad. There's a lot of ways I can go with this, but I've been watching this YouTube channel, and we'll get into it. But it was kind of talking about the same thing, where this is really extreme, but people are buying plots of land and just building little shacks on it. But his big point was, because so many people are being priced out, like that's the only option for someone unless they want to take on this massive mortgage and really help or really hurt their long-term future. So people are starting to get really creative with how to do that. I think typically when interest rates come down, that does drive some more activity in the real estate area. Good and bad. Interest rates coming down typically lowers your price of your mortgage per month. But it also does create an environment where real estate prices tend to grow a little bit more. So I don't see a crash in the real estate market like 2008. If anything, maybe it kind of flattens out a little bit and doesn't grow at nearly the rates it was growing. but real estate tends to do well in an inflationary environment. And if we stay in an inflationary environment, then real estate will probably continue to steadily go up, but probably not at the rates of growth that it has gone up. So, for those looking to buy a home, maybe I know this is hard and it's a personal decision, but look for less home. Look for a condo, or look for something that you can go a little bit further outside of the city to find lower prices. I think sometimes it's better to have a lesser home than no home at all, especially in an inflationary environment. Now, there is a chance we could go into a recession, and then you start to see a lot of the default rates start to increase. And that could put downward pressure on real estate at that point. But I think the more likely case scenario is that the growth of real estate just slows, but continues to grow. I mean, it's going to depend on where you're at in the country and how much real estate prices have grown, but nationally, that's what I think is more likely case scenario.
That's good. As we say, there's a lot of moving parts, obviously, to all of this. If interest rates are lower, then you can afford potentially a house from a mortgage standpoint. So timing of that could be a factor. But at the end of the day, we always encourage, and I'm biased as the director of financial planning here at AllGen, tie it into your financial plan. What is your financial picture? What's your liquidity look like? What do you need to see happen for your financial future? So we hope this has been helpful. We encourage you to reach out to us with any other questions, or to your financial advisor if you'd like to delve deeper into any of these topics. We wish you a great end of the year, great upcoming holiday season, and we hope to see you soon. Thank you. Have a great day, everyone.
Thanks, everyone. Take care.